Imagine a world where the banks you trust with your money are on the brink of a crisis. That's the reality we face today. Recent reports and articles are painting a rather gloomy picture of the banking sector's future. We are standing on the precipice of a potential banking crisis, and the indicators are everywhere if we dig a little deeper. To understand the gravity of the situation, we must first grasp the Elliott wave analysis methodology. This approach, rooted in the ebb and flow of investor psychology, has been a reliable predictor of market trends. Historically, it's shown us that long-term bear markets are often imminent when optimism is at its peak, and right now our financial markets are a ticking optimism bomb. Now, let's take a look at the current banking landscape. China's banking regulator is probing into local and foreign lenders' property loan portfolios, assessing systemic risks in the real estate sector. This move comes as the property sector crisis worsens, and there's a potential threat to banks' asset quality. On the other side of the globe, Bank of America is sounding the alarm bells. They warn that commercial real estate loans could be the next domino to fall in the ongoing banking crisis. With office occupancy rates still below pre-pandemic levels and national rent levels falling, the sector is at risk of a credit crunch. Regional banks, accounting for 68% of such loans, are under significant stress, reducing their ability to modify loans. But perhaps the most disturbing revelation is the potential for a higher percentage of bank failures in the coming years. If predictions hold true, we could see a 62 to 80% stock market decline. The impact of such a downturn would be catastrophic, with the potential to dwarf the great financial crisis. The stakes are high, and the threat is real. It's time to ask ourselves, are we prepared for a banking crisis? Across the globe, banking systems are under scrutiny. In China, the Banking and Insurance Regulatory Commission is investigating the property loan portfolios of local and foreign lenders. This probe is not your ordinary regulatory check. It is an explicit endeavor to assess systemic risks in the real estate sector and determine if banks' credit decisions were made according to the rules. The focus of this investigation is the exposure of banks to developers. It's worth noting that property loans accounted for over a quarter of total banking sector credit in China as of mid-year. The probe arrives at a time when the property sector crisis is escalating, with defaults among developers and a slump in home sales. The regulator is also requesting details of developers' cash positions and the sources of money for debt repayments. The investigation is thorough, and loan officers are being approached multiple times for additional documents. This meticulous probe reflects the seriousness of the situation. Now, let's discuss the implications of this probe. The risk of new non-performing loans is a looming threat to banks' asset quality. At the end of June, commercial banks' non-performing loan ratio stood at 1.67%. A further increase in this ratio could significantly impact a bank's profitability and overall stability. But the ripple effects of this crisis don't stop at the banks. Secondary industries such as asset management companies, construction firms, and even small steelmakers could also feel the heat. These industries are closely tied to the property sector, and a downturn in the latter could significantly impact their operations and financial health. In conclusion, the Chinese banking probe is a significant development that could have far-reaching consequences for the global financial system. It is a stark reminder of the interconnectedness of today's economic landscape and the potential domino effects of a crisis in one sector or region. As the property sector crisis worsens in China, the global financial system braces for impact. Commercial real estate loans could be the next domino to fall in the ongoing banking crisis. The sector teeters on the precipice of a credit crunch, with upcoming refinancings of commercial real estate loans at higher interest rates looming. This credit crunch could be the catalyst that triggers a downward spiral in stock prices, potentially driving us into the clutches of a recession. The crux of the issue lies in the fact that office occupancy rates are still languishing below pre-pandemic levels. National rent levels have been on a downward trajectory, and the market prices for stocks and debt tied to commercial real estate have shown signs of weakness. Let's delve into the role of regional banks in this unfolding drama. These banks have significant exposure to commercial real estate loans. To put this into perspective, United States regional banks account for a staggering 68% of such loans. There is an impending maturity of approximately $450 billion in commercial real estate loans in the year 2023, with about 60% held by banks. The forecast is grim. JP Morgan predicts that about 21% of outstanding office loans could eventually default. This could result in a whopping $38 billion in losses for the banking sector. The current situation could potentially outdo the great financial crisis, considering the prolonged impact of work-from-home trends. Regional banks are under immense stress, which reduces their ability to modify loans. To stave off this impending crisis, regulators are urged to take emergency actions. However, the outlook for commercial real estate continues to weaken, and the large amount of maturing debt could lead to an onslaught of defaults. This could negatively impact bank stocks, potentially causing a recession. With a large amount of maturing debt and weakening outlook for commercial real estate, we could be on the brink of a banking crisis that could send shockwaves through the global economy.